Last year, while everyone was focused on the AI giants, three unknown tech companies quietly delivered gains of 700%, 1,000%, and even 1,100%. And right now, they're showing the same exact pattern that they had before they went up over 500%. Today, I'm sharing those three stocks that most traders are completely missing. I'll show you where to get in, where to put your stops, and where the stocks could likely go if they make up these big moves. But before we dive in, make sure to grab our free investment guide from the link in the description. At Profit Punch, we find the top 1% of stocks and tell you exactly when to buy and sell, while taking you from a complete beginner to a skilled investor. Our beginner-friendly guide shares the exact patterns that helped our members make massive wins, like NVIDIA's 200% move in 3 months, SMCI 250% in 2 months, and Upfolio 350% in 3 months. Don't miss out on our next big call. Now let's break down each of those opportunities. The first one is a nuclear tech company that went up over 260% last year, and it's already up 200% this year. It's called Oklo, as you can see on the screen. So what we like to do is to have our earnings table. We like to have our earnings table. As you can see, it's an IPO. We just have to depend on price action, and let's see what happened in the past. So I do have my weekly chart, and on the weekly chart, I put the 10-week simple moving average and then the 30-week simple moving average, which guide us as long-term investors of where to know where it's going. And on the daily chart, I put a 20-day exponential moving average and a 50-day simple moving average. Last year, the company came as an IPO. It crashed immediately. It made this big base. And then we start to see this small cheats. So cheats are the first times you can try to enter into a stock. And as soon as it breaks out of this cheat, what you want to do is put your stop right below this price structure breaks. What you want to do is buy above the cheat, and then your stop is always right below the price structure break. So here you could have had a 15% risk, and then you could have made 12 times your money back. And then we see it forming a long base again. So if you want a very good base, you want it to be at least 10 weeks. Those bases which are 10 weeks and above, they produce bigger moves. Of course, if a base, which is this consolidation, has about 3 weeks, 4 weeks, it can create a move, but those moves are generally smaller. And from my experience, I've realized that it might be better to just wait and try to catch the big moves. You can catch the small moves, but you have to catch so many of them. So it comes up, starts to form this base. We like to see something called a checkout. So it comes here and checks out. Whenever you see these checkouts, that's the first time to pay attention to the stock. It comes and forms this cheat here, and then it breaks out again, and I can show you where you could have put your stop loss. So you buy as soon as it breaks out there. Your stop loss is about 18%, very wide stop losses, for these longer term moves, and then you just wait maybe 6 weeks. You could have made 7 times your money back. So let's say on this trade you risked 1% of your account, you could have made 7% of your account, which is a very good return. And then in that same way, let's look into the other stocks which are just beginning their moves. In this particular example, I was trying to show you what these stocks can do. We saw the big move from last year, 300% move, and then we can see that this year it has already gone up about 200%. The next stock is a simple robotics company that's forming something called a virtual contraction pattern, something I learned from Mark Minervini. And this reminded me of something that I saw right before NVDA broke out. So what are we seeing in this serve stock? We have to pay very close attention. So virtual contraction pattern is when you like this is when you see that the stock has smaller and smaller contractions. The first time it comes and does 70% correction. Second time, 40% correction. So it's getting smaller and smaller. Third time, it does 34% correction. This means that while it's forming this base, you have two options. You can either buy within the base, or you can wait for it to break out of this base. So I'll show you some good trading opportunities that we had. The first one was here, right? So you see it forms this nice chit, and then you'll just buy right above here, put your stop right below the price structure. 17% stop, you could have made 7 times your money back. So same thing that we are seeing here. So what we do is we can see it's breaking out of this sideways action. It's breaking out on volume. I like to see this volume down here. You want to see it breaking out of those chits on volume. So here it did break out on volume here. We can see that again. So what I would do for this one is I would put my stop below the break of the structure break, maybe 16% stop or a 20% stop. It looks very wide, but for these stocks which can make these very big swings, because last year we saw that it went up 800%. It breaks out of that shit. Of course, you're not probably going to buy it here. You probably could only have gotten it on that big breakout. But then from there, you could have still made a 470% return. And for such stocks, of course, you don't want your whole account to be in these stocks. You just want to allocate maybe just one of your positions to these stocks, because once they move, they can make you really big money. So here, we don't know how far it can go. Is it going to make an 800% move? I don't know, but from such a very, very, very big base like this is more than 26 bars of a base. I would say that if this thing breaks $25 and goes up in price, you just want to hold it until it closes under the 20-day simple moving average. I wouldn't be surprised if this thing goes up even 300%. So you can make 20 times your risk back. So if you risk 1% of your account, let me say 1% is $100, then you could make 20 times that. So $2,000 by risking $100. And those are the type of trades we like to take. The next stock is a defense stock. It makes drones. So we see our weekly chart. We see a very, very good big uptrend, right? So we see it breaks out of this long-term base. Whenever stocks break out of a long-term base like this is when investors can get in. These are very long-term traders, because you have to know where the stock is in its price action. Do you want to be an investor, or do you want to just swing and hold it for a while? For these very volatile stocks, it's not very good to be an investor, because they can have very huge dips of maybe 50% correction. So normally they're just good for swing trading. But if you're one of those people that has diamond hands and you're willing to hold this thing on this very big breakout with volume, this is a very clear reversal pattern where you know the stock is going through some major accumulation. The thing has gone up almost 1,000%. So that means whatever money you invested multiplied times 10. If you put in 10,000, you would have picked out 100,000 from the stock. Of course, it's easier said than done because of all of those swings, but that is just the case. So last year, let's see what the thing did. From the big breakout, we can see it did about 900%. And that is something we expect, because this is something we call base one. And after this, we can expect maybe just one or two more bases, right? So this is base one. You want to know the stage analysis of your stock. So these very long big bases are what we call initial bases. And from such big bases, stocks can run like this for a very long time. So this is what I would call base one. This is base two over here. Then this is base three. So the best times to buy are base one and base two. Base three is always a swing trading opportunity because it cannot be fully trusted. The stock has already gone up a lot. So what we are doing here is just like what you could have done in the past. So you see this chit here, comes down, forms a nice consolidation. This was in base one. You can see it's at least 10 bars, right? So what do you do there? As soon as it breaks out of the chit, put the stop right below the price structure break. You don't want to be having random stops. I used to have random stops, but I realized that they don't work so well. So risk about 12%. The maximum profit you could have made on this particular swing trade, let's say you're waiting for it to close on the 20-day simple moving average, was about 13. 13 times your risk. So if you risk $1,000, you're making $13,000 from this trade. If you risk $100, you make $1,300, which I think is a very, very, very big return. So then it comes, sits down for a while, does the same stuff like I told you. You're looking for one of two things. We're either looking for a checkout, because we have a horizontal line here. We like to see these checkouts. They're good signs. These first two checkouts, they wouldn't be trustworthy because, as you can see, the stock has not made a very, very good base yet. This one, of course, just don't get in because it was just consolidated for just about maybe 4 weeks. It's not very ripe after such a very big move. Stocks, once they make these big moves, they want to sit down for a while, right? So you have to wait for them. So let's say you got in on this first checkout. You can start building your positions like this. Maybe you bought here, right? And then you risked right below here. So it went up and then it just didn't break out, Then it comes down again. So here, this first trade, you could have gotten out and scuffed, and then it comes, forms, we don't see a checkout, but then now we see a chit, and we can see the chit, it has formed after the price has matured, because we want the base to be mature. And then after that, it does a 200% move. How much could you have risked? Because what we like to know is not about how much we are getting, but how much are we risking to get that? You could have risked about 8%. Let's say on the breakout, you risk about 10%. You could have made 24 times your money back. So if you risk $100, you get $2,400. If you risk $1,000, you get $24,000. And here we are seeing the same thing Again, it comes, forms this chit, right? So we see the price has matured. You see that same chit, the same as we saw the other times. So what do you do there? You just buy here, put your stop down here, never risk. On these ones, I like to risk maybe at most 0.8% of my account. So if it goes bad, I know that I've risked 0.8% of my account. I'm not hurt. And then after this, I can expect a very big move. So you can either wait for it to close another 10-day, or you can sell at a specific profit target, which we talk about in the newsletter if you go check on the resources page. And then the last stock is NNE. This is one of the best breakouts. I was keeping it for the last, and this is something I'm just sitting and just waiting to see what happens. Like I told you, these are IPOs based purely on price action, but we've seen that these things can move. So we like to see very, very simple, clean moves. So we have our weekly chart. We can see the thing is pretty new, right? But what are we seeing? Let's see what it did last year. Last year, it comes and does this IPO U-turn. So these IPOs, I won't trust them unless they're trading at least 1 million shares a day. So this thing, I couldn't have bought it here. It didn't have 1 million shares. It's not trading at least 1 million shares. Maybe during this consolidation, I could have bought it. But I'm just trying to show you what could have happened. So it comes down here, forms this IPO U-turn. Stock is right below the low of the price structure break. You can risk just 0.5% of your account on this, And if it goes 30 times your risk, that's 30 times 0.5. So you've made 15% of your account, yet you just risk 0.5%, which I think is a very good return from just one stock. If you risk 1% of your account, you make 30%, but I would never risk 1% on such stocks. So you can see this thing went up a gazillion times, 600%. And then what did it do? I told you the stocks like to sit for a while, right? And this one, I don't see kind of, very nice patterns that were happening. Maybe this could have been a checkout, but I don't think I could have bought it here. It didn't look good. You don't like stocks that have corrected, much more than 40%. This one had corrected 80%. So, of course, it couldn't be trusted. Maybe you could have tried to get into some cheats here. Stop would be right below the price, this price structure break, but it really didn't go anywhere. I tried to get it again here. You see, sometimes these things will fail. Let's say you try to get it here. So you get out, you break even. Here, maybe you lose 0.5% of your account. Okay, that's sad. And then what happened is that it breaks out on volume. So this is a very, very long-term breakout. And this is something we also call a virtual contraction pattern. So remember what we talked about earlier in the video, virtual contraction pattern? So what happens is that, you see here it corrected 80%. It comes up again, and then it corrects another 40%. Then it comes up again, corrects another 29%. So it looks like, hey man, as soon as it goes in, let's buy it. And that's why I actually tried to buy it here, and then it didn't break out. It just disappointed me, and then it shook people out. So I did get checked out. And these checkouts are actually a good sign. Why are they a good sign? These checkouts mean that there is some hedge fund manager out there that has a lot of money that pushes the price of the stock down, scares out people, and is able to scoop it for himself. So he scooped it there, and the stock went up to 99%. Of course, I'm sure he hasn't yet sold. And why do I know that these people have not yet sold? Is that it is coming back on lower volume, right? You see the breakout was on very, very high volume. It breaks out on volume, very violent breakout, and then it returns to the breakout level. And why is this trend line trustworthy? We trust a trend line when it has been tested at least 3 times. So here we see 1, 2, 3. So this is a very valid trend line. Breaks out on volume, returns on low volume. So I bought here on the breakout, and then what you could do is that you could add here. So if you don't have this stock yet, you know what I did. The problem with this one is that I don't see a very good price structure to support. So I did put my stop here around 25%. I'm waiting for I put a very large stop. And then I am just waiting for it to cross around $43. Once it breaks out of this thing again on volume, I'll just double my position and then raise my stop to be about $31. And that is the last recommendation. If you found value in this video, please subscribe to the channel, because I spend a lot of time looking at these stocks and I try to bring them for you before the market opens so that you can profit from them. This is more of a position trade. It might not move immediately, but risk is the most important. Don't risk more than 1% of your account in these trades. Please risk about maybe like 0.4, but you gotta wait for these things to move, and they do take their sweet time. Please subscribe to the channel, subscribe to the newsletter as well, because I release newsletters as well as soon as the stock breaks out. May the markets be with you.